Lesson 18. Interest rates. Now remember, the market is focused on whether or not the central bank is likely to move interest rates and in which direction. So if together the economic data suggests growth, then it's more likely that the central bank will raise interest rates to control the inflation caused by the growth. And this is because rising inflation will negatively affect growth. And you can understand this because rising inflation will result in increasing prices, and increasing prices will result in decreasing demand. And decreasing demand will result in decreased production, and less production means less growth. So increased inflation can immediately stop growth. The central bank has to control inflation so that we can have sustained growth. Remember, decreased production also results in increased unemployment, because if producers are producing less, then producers don't need as much workers. So inflation can greatly affect growth. So the central bank has to keep a close monitor on inflation. Now, if the data suggests a slowdown in the economy, then we expect the central bank to likely lower interest rate. And this is the opposite. If the economy is slowing down, then the central bank could lower interest rate to pump more money into the economy to increase demand and increase production. Okay, so if the economy is slowing down, we expect the central bank to lower interest rate, and if the economy is growing, we expect the central bank to increase interest rate to prevent increased inflation. Now, section recap. So remember, always focus on how likely the news release will be in affecting the current sentiment towards interest rates. So we always want to look at the bigger picture. You need to ask yourself, how will this news release affect the central bank's position on interest rates? Will this news release influence the central bank to increase interest rate or to decrease interest rate? Remember, the higher the interest rate, the more attractive it is to investors who are looking to gain interest on their capital. As a result, whenever a country raises interest rates, we tend to see an increase in demand for that country's currency. So remember, increased interest rates is positive for a country's currency. Now, as a Forex trader and trading fundamentals, you need to ensure that you understand the positions of each of the main central banks on their country's interest rate. So once you know how all the central banks are positioned towards interest rates, then you have a broader picture of what to expect for the currencies. So as a trader, one of your main objectives is to know what the central banks are thinking as it pertains to interest rates for their specific country. Okay? This is Luciano, head of currency trading and owner of Loretta FX, and I'm saying thank you guys for taking this course, and always remember, all men are self-made.